Welcome back to most of you to the Peterson Institute for International Economics. I was torn between finishing chewing and starting on time. Tried to do both. We're having a special afternoon session, and I think it's a credit to both the interest of the subject and our distinguished speakers that we got such a great turnout without offering anybody lunch. So I commend you all. We're here today to talk about sovereign debt restructuring, which is obviously a very critical issue. The sort of sexy part, as it were, of recent months is, of course, Greece and issues in Europe. But as the people in this audience are well aware, there also was a very important court decision recently having to do with Argentina, which is setting precedent. And then we had some news today about, I think it was Spain was issuing its first bonds with caps in them. Whole nest of issues requiring a great deal of sophistication, judgment, market and political realism to do the right thing on. And for that reason, I'm very grateful that we have the panel we have here today. It's also a point of personal pride, I'll explain in a moment, to have these particular three people. Who's going to be leading off is Jeromin Zettelmeyer. In the academic community in the fund and now at the European Bank for Reconstruction and Development, where he's Deputy Chief Economist and Director of Research, Jeromin has been an intellectual force on these issues for some time. He and a co-author did a wonderful book looking at the sovereign crises from the mid-90s through 2006. And at some point, we may trouble him to reflect back on what was right and wrong about that book, but that's for another occasion. Not that anything was wrong with that book, but what you might update as a result of the last few years, I guess is the way to put it. I am very proud to say that Jeromin is joining the Institute as of today as a part-time senior fellow, a non-resident senior fellow, in part thanks to his initiative and the good graces of Eric Bergloff, the chief economist of the EBRD. But this is the start of what we all expect will be a very long and fruitful association with Jeromin. And so this is all of you getting to see his debut on the Institute stage, which we're very proud of. So welcome, Jeromin. Sitting next to him, but speaking third, is Professor Anna Gelpern of the American University School of Law. I know she has a few fans, if not a whole-on claque following her here today, and you're all welcome. Welcome to the Institute, which generally does sponsor pretty interesting discussions. And we'll hope to have more of them. As many of you, I hope, know, Anna served with distinction in the Treasury at the Clinton administration, has been a frontline lawyer in a leading commercial law firm, and for the last several years has been teaching at American with distinguished visiting appointments at places including now Georgetown. And she is at the absolute forefront of bringing together law and economics, something which Jeromin does as well. In fact, it's hard to think of two people who are as well-versed on both sides of that as these two. And we're looking forward to Anna's remarks. And in particular, she's going to be able to bring us more up to date on some of the implications of the recent court decision. Finally, on the panel, but speaking second, is Bill Klein. Bill Klein should need no introduction, but after Barney Frank the other day made fun of me about saying, without further ado, I will give a bit of introduction. Bill is, depending how you count it, employee number 1, employee number 2, or employee number 3, but no more than 3 of the Institute, along with John Williamson and Fred Bergston. And he is arguably, in sheer volume and depth, the most productive person we've ever had at the Institute. One of the things I inherited from Fred Bergston is to be able to count on Bill to come out with a rigorously done original methodology, entirely topical study with freakish regularity. Bill is in the midst of a project where he has come up with a new method for thinking about public debt sustainability issues with a probabilistic perspective. Some of you have seen his early publications from the Institute on that. They're on the website. And he's going to be sharing some of his insights from that work on today, looking at Greece and some of the other European countries. Anyway, it's a very exciting program. We will end promptly at 4. The idea is to have our 3 speakers speak for somewhere between 45 minutes and the first hour combined, and then open it up for questions and comments. And just for the record, the first question and comment goes to our friend Mikas Hajmichael, and I apologize for mangling the pronunciation of the second name. He is here as a representative of the Institute for International Finance, where he's Director of Emerging Markets Policy. And we have a number of recent publications by the IIF on these issues available out in the lobby as well. So without further ado,
thank you so much, Adam. I'm hugely honored and flattered, and also a bit nervous to be up here, seeing so many former IMF colleagues and colleagues from the Institute and others that really know a lot more about the topics of today than I do. I do this, as an amateur. I worry normally about transition economies and development issues and so forth. So I'm going to make 2 points in my remarks. I will make a point about Greece, and the reason for starting with Greece, I think, is that Greece was, and to some extent still remains, the potential main threat to the integrity of the Eurozone. And so I think it's useful to start by asking where we stand on Greece following the late November restructuring of payment terms to the official sector, the OSI, if you wish, and the buyback and the extension of the program. And then and sort of the flavor of my remarks on Greece I'm going to be sort of neutral to positive, to optimistic. And then I will just give you one thought on the remainder of the high debt countries in the Eurozone, and there maybe the flavor is going to be neutral and possibly a little pessimistic. So let me start with my point on Greece. So the question is if you look at the press that particularly the buyback got in December, it's generally fairly negative press, and so I think one has to ask the question, beyond the short-term relief of having had the disbursements, enabling the recapitalization of banks, and continuing, keeping the game on the road for a while, was this OSI and buyback useful, or was it just another case of delaying the inevitable? Clearly, the OSI was not as big as many, including here in Washington, would have hoped. And so my answer to that question is really both. It is a case of delaying the inevitable, so this is one case, but in my view, presumably not the last case of official debt restructuring in Greece. But it nonetheless was useful, even very useful, I think, in at least 2 ways. First, I've done a little bit of number crunching to find out whether there is a basis for the argument that the buyback was purely a boondoggle that helps the creditors, and the answer is, the creditors did in fact obviously make money on this. That was inherent in the market-based approach. You can see that merely from the fact that prices picked up by in the order of 25% since the buyback was announced, even though of course that also would reflect the effect of the program extension, the OSI, which are separate. But nonetheless, there was some actual debt reduction in a real sense, in a present value sense. So when you combine both operations, the buyback and the official sector involvement, you get something, and this is really preliminary, really rough, in the order of 20% of GDP. So this is a lot less than the PSI was, but it is something. And of course, one has to point out that from the official sector perspective, this is the second time that, at least, possibly the third one, depending on how you count, that Greece's payment terms were eased. Now, the second sense in which this was useful, and this one is actually far more important, is as a precedent. So in my view, this demonstrates what you might call a soft OSI, a soft official sector involvement approach that can be repeated further down the road if necessary. So it is really about focusing on sustainability in a flow sense. What can the country pay at any given time? And then keep postponing the problem. And at the current level of debt, at the very low interest rates that these OSIs will gradually go to, you will then, I think, end up at something that you could call sustainable debt. Of course, it's politically still very unpleasant. It still involves a regular repeat of this game, and it does mean that Greece will be dependent on official financing for a long time, unless then the step is taken at some point to go for a bigger cut, and that jury is out there. The result, however, of this, with or without a bigger cut in the official debt, is that, in my view, the probability of a second PSI has become far less likely after what we have seen, both because of what it reveals about how the official sector will handle this, and ironically, and so this is the sense in which the buyback is a problem, because the buyback has selected effectively those creditors out of the creditor pool that would have gone for an orderly restructuring. What you're left with is presumably a group that is far more likely to put up a fight if there were a second attempt at a debt exchange. So the combination of having the private sector debt quite low and the composition of that group, I think, makes the second PSI far less likely. Okay, now I just came back from talking to some people outside the building who sort of accused me of being very mechanistic and sort of obsessed just with the debt problem and missing the big context, and the big context is growth. And so what about growth in Greece? So I think that even here there may be a little bit of a reason for optimism. So the usual argument of why you need a much more maybe radical operation to deal with to invite a recovery of growth and what was happened in November, December is the debt overhang argument. And roughly the debt overhang argument works through the expectations of future taxation. So the argument is that investors are much likely to come to Greece, including and particularly in the private sector, because they expect that the continuing difficulties in the private finances will in the future be clawed back from them in some form or the other, typically through higher taxes, lower subsidies, something of that sort. Now here I think that Greece is indeed a bit different where we are at this point. And the argument is that whatever you may think of what will happen with respect to official sector debt restructuring in the future, it is, in my view, extremely unlikely that it would result in more austerity in an attempt to do a higher primary surplus, right? So roughly the model, the debt overhang story, is that when it comes to renegotiate the debt next time, there will be some attempt to redistribute the burden of taking the hit, if you like, between the official sector and even higher taxes. And I think we are in Greece, clearly be past that point. So I think that it is probably fair to see the 4.3% primary surplus as a sort of an upper bound of what realistically will be achieved in Greece. And once there is the next debt renegotiation, if anything, there will be a further easing on the austerity. And so in that sense, none of this is going to get you a huge stimulus, but combined with on the back of the huge compression, the very large output gap that exists now, I think there is some sense that Greece may turn around this year or next year. There are, of course, big risks. The risk number one, I think, is I'm not really connected with the German political scene, but my superficial impression is that Greece really was very close to losing the patience of the official sector, and the reason why it did not is because France and Germany felt they needed to give the new government a chance. If the new government does not deliver on this chance, it may be different next time. And then, of course, needless to say, there's the continuing risk of a social explosion, because even this so-called optimistic scenario I have described to you is one that involves low growth and high unemployment for a long period. Okay, after this optimistic picture, let me just quickly say something about the other Eurozone countries. So I haven't done any real serious analysis of these, and part of it is that one has to work to one's comparative advantage, and we have Bill here on the podium who has done a very serious analysis of debt sustainability. And so, rather than trying to compete with Bill in this area, I'm just going to give you sort of a very simple framework to think way of, I'm going to put into your head an idea of how do you think about the likelihood to get out of the debt problem in the remainder of the European Mediterranean countries. And that's the logic of this beautiful chapter in the last World Economic Outlook that operates historically. It looks at a group of attempts to reduce debt from levels above 100%, and it basically asks the very simple question of, did they succeed, within a reasonable period, a decade or so, in lowering debt below 100% and putting it on a downward sloping path. So it's somewhat loose criterion of success. And so they spend a lot of time, it's a case study basically, there's some econometrics, but it's basically a case study of a handful of cases, the UK between 1918 and 1933, Japan in the late 90s, the US just after the Second World War, and then Canada, Belgium, and Italy between the mid-80s and the 2000s. And so this includes both successful cases and failed attempts. So the failed attempts are the UK and Japan. The US is a successful attempt, and the others struggled initially and eventually became successful. So there were two phases there. One, a very sort of protracted attempt of doing it with austerity alone, which did not work, and eventually things came together. And so, but the basic takeaway from that chapter is that fiscal adjustment is necessary but not sufficient. And what you also need, the extra ingredient that you need, is accommodative monetary policy. And from here, it's very easy, and in fact, people like Martin Wolf have done that, to construct, a real impossibility theorem for the Eurozone, because clearly the ECB's mandate is such that it arguably prevents it from running a monetary policy that might be sufficiently accommodative to accompany the fiscal contractions in the high debt countries and keep the show on the road. And then on top of that, you have these self-fulfilling expectations that increase sovereign risk, worry about the breakup. This all gets reflected in higher interest rates in the periphery, conditioning on a particular ECB monetary policy, and offsets, or more than offsets, the little bit of stimulus that the ECB does impart. So this is this financial fragmentation argument. And so, clearly, if we're going to get around that problem, we will need to find some sort of substitute for easier monetary policy in the Eurozone. So one option, sort of one way of interpreting the OMT, is as providing that sort of substitute. And so it has worked well, I think, in lowering rates, but there is a limit to which it can work, because it's calibrated, quite deliberately calibrated by the ECB to take away only the, if you like, the self-fulfilling portion of the risk, right? It's not to generate negative real interest rates in those peripheral countries, which is by and large what the successful experiences had for some time. And so the question is that this is enough. And so here I actually tried to do a little bit of a quantitative exercise. I ran some simulations based on real projections and sort of current interest rate, the lower interest rates, and looked at whether the debt would be sustainable in this very crude sense of the WEO chapter, whether it comes down within a period of about 10 years or not. And so when you do that, the answer you get is that it works for Italy, even under pretty pessimistic zero growth, real growth assumptions. And that's largely because they already have a primary surplus, right? So they've already done the adjustment. But it's far less clear for the others, that particularly like in the case of Spain, still have the adjustment in front of them. And so there's real sense that for these countries we might need something else on top. There is another substitute for easy money. And we don't want that substitute to be a Eurozone exit. So what might that be? And so the next best thing I can think of is the old idea of the German Redemption Pact that was launched by the German Council of Economic Experts about a year and a half ago. And so the idea of that is essentially that on top of this, what arguably is like a stock support of the OMT, you put in a flow subsidy. So on the new debt issuance, you put in a guarantee, and that is a relatively efficient way because you're only guaranteeing the new debt, but you're doing it for a long time, of ensuring that the debt dynamics are on a good path. This would have to be conditional, obviously, on adjustment, otherwise it is completely unthinkable in the European context. As such, it could be conditional on the same things that the OMT is conditional on, namely a program. But the thing about this that is because it's not just about breaking the panic, but it's about improving the debt dynamics over a sustained period, you require much further reaching a commitment, a longer horizon, and that is difficult. And then the other substitute, if that doesn't work, is just debt restructuring, some attempt of orderly debt restructuring. So what are the risks here? Well, the obvious risks is that the underlying program commitments that are necessary both for the OMT and for something like the Debt Redemption Pact might not be there because of continued political resistance to them. Now that I think I take a little less seriously, because I think that if rates went back up, if the debt dynamics deteriorated, probably that would be enough to get, say, a country like Spain over that hurdle where they would finally ask for a program. But then the other risk is that, assuming that the program commitment works and we do actually do something like the Debt Redemption Pact, what you would get is a very long deflationary drag, right? So it would be adjustment, but it might even be successful adjustment, but it would be very long adjustment. So it might be that the best scenario in that case is successful adjustment, but at the expense of a lost decade as far as growth is concerned. Thank you.